put your phone or device aside and immerse yourself in this audio story. Perfect for listening on the move, while relaxing, or for bedtime listening. We release new stories daily, so make sure to like and subscribe to not miss out. This story is based on true events. The Shadow Network. Nobody's watching. In the autumn months of 2025, something began shifting beneath the surface of global markets. Not a crash. Not yet. But a series of fractures, quiet, systematic, spreading through the foundations of the financial system like hairline cracks in a dam wall. Corporate bankruptcies that shouldn't have happened. Debt levels that defied historical precedent. Crypto markets convulsing in ways that mirrored the panic of 2008, but with digital chains instead of mortgage-backed securities. And behind it all, a question nobody in power wanted to answer. Had we built the same house of cards again, just with different materials? This is the story of a financial nightmare unfolding in real time. A dark business story about the invisible forces that might be engineering our next great collapse. The warning signs didn't arrive with sirens. They came as whispers from bankruptcy courts, as tremors in credit markets, as unexplained volatility in assets that were supposed to be stable. By November 2025, the corporate debt market had swollen to over $10 trillion in the United States alone. A figure that had doubled in less than 15 years. Companies that had gorged themselves on cheap money during the era of near-zero interest rates now faced a reckoning. Refinancing became a death sentence. The bills were coming due, and the interest rates had changed the game entirely. This wasn't just about individual company failures. This was about systemic risk, the kind that doesn't announce itself until it's already metastasized throughout the entire financial system, binding institutions together in a death grip of interconnected exposure. The first major domino fell in early 2025, though most people didn't recognize it as such. WeWork, the shared office space company that had once been valued at $47 billion, filed for Chapter 11 bankruptcy in November 2023. But the real damage didn't fully manifest until landlords across major cities began calculating their losses 18 months later. Commercial real estate portfolios that had been considered rock-solid investments suddenly showed massive holes. Regional banks with heavy CRE exposure started showing stress indicators that risk managers tried to explain away as temporary adjustments. But the pattern was forming. The shared workspace revolution had been funded with mountains of debt. And when it collapsed, it took entire property portfolios down with it. Office buildings in Manhattan, San Francisco, London. Prime real estate standing empty, unable to command the rents needed to service the loans used to acquire them. The commercial real estate sector had become a ticking bomb, and WeWork's collapse had started the countdown. But real estate was just one thread in a much darker tapestry. Across the corporate landscape, zombie companies, firms that earned just enough to service their debt, but not enough to actually grow or invest, had proliferated like a cancer. The Bank for International Settlements estimated that by 2024, nearly 20% of publicly traded companies in advanced economies qualified as zombies, kept alive only by the artificial life support of cheap credit. When central banks finally raised rates to combat inflation, that life support got expensive. Prohibitively expensive. One by one, these corporate undead began their final death march into insolvency. Bed Bath & Beyond, Party City, Rite Aid, companies that had been household names for decades, suddenly vaporized. Each bankruptcy sent ripples through supply chains, through commercial paper markets, through the web of counterparty relationships that bind modern finance together in ways most people never see. The leverage had been building for years, hidden in plain sight. During the pandemic, when governments opened the monetary floodgates, corporations didn't use the cheap money to build resilience. They used it to buy back stock, to fund acquisitions, to finance expansion plans that assumed the good times would last forever. The corporate debt-to-GDP ratio in the United States climbed above 80%, levels not seen since the immediate aftermath of World War II. But this wasn't war debt. This was leverage taken on in pursuit of quarterly earnings targets, of executive compensation tied to stock prices, of private equity firms engineering financial alchemy with other people's money. The machine had been designed to extract maximum value in the short term, and nobody wanted to think about what happened when the music stopped. Now, in 2025, the music was stopping, and the silence was deafening. The credit markets began showing strain in ways that evoked uncomfortable memories. High-yield bond spreads, the premium investors' demand to hold risky corporate debt, started widening beyond what fundamentals could explain. It was a fear premium, a recognition that something wasn't right in the plumbing of the financial system. Covenant-light loans, the kind of corporate debt that gave lenders almost no protection if things went wrong, had exploded during the low-rate era. By some estimates, they represented over 80% of the leveraged loan market. Translation: investors had been so desperate for yield that they'd lent trillions of dollars to risky companies with essentially no strings attached, no ability to force changes if the companies started failing. It was the subprime mortgage playbook all over again, just wearing a corporate suit instead of residential housing clothes. And the people who had engineered these structures, the investment banks, the private equity titans, the credit fund managers, they knew exactly what they were building. They'd done it before. Then came the revelation that changed everything. The shadow banking system had grown even larger than anyone realized. In October 2025, the Financial Stability Board released a report showing that non-bank financial intermediation, hedge funds, private credit funds, money market funds, entities outside traditional banking regulation, now controlled over $220 trillion in global assets. That was more than double the size of the regulated banking sector. More than double. And these entities were deeply interconnected with banks, with pension funds, with the entire financial ecosystem, through derivatives, through repo agreements, through chains of lending and borrowing that nobody fully understood. The systemic risk wasn't just in the banks anymore. It had metastasized into a vast, largely unregulated parallel financial system that had become too big to map, let alone too big to fail. When regulators tried to stress test this system, to understand what would happen if major players started failing, they discovered something terrifying. The data didn't exist. The interconnections were so complex, so opaque, that nobody could actually model the cascade effects of a major collapse. We had built a financial weapon of mass destruction, and nobody was holding the instruction manual. The private credit market exemplified this darkness perfectly. As banks retreated from risky lending after the 2008 crisis, private credit funds stepped in to fill the void, and then expanded far beyond it. By 2025, the private credit market had swollen to approximately $1.7 trillion globally. These funds, run by firms like Apollo, Blackstone, and Ares, had lent money to companies that couldn't access traditional financing, often at interest rates well into double digits. The pitch to investors was simple: higher returns with direct lending expertise. The reality was more sinister. These loans existed in a regulatory shadow zone, with limited transparency about how they were actually performing. Mark-to-market valuations, the daily price discovery that keeps public markets honest, didn't apply. Fund managers could essentially decide what their loans were worth. And surprise, they almost always decided the loans were doing just fine, even as the underlying companies struggled. It was the perfect setup for a liquidity crisis. Investors thought their money was safe in these stable, high-yielding funds. But the moment they all tried to get their money back at once, they'd discover the truth. Many of those loans couldn't actually be sold at the values the funds claimed. The exits didn't exist. And then there was crypto, the wild card that connected everything to an entirely new dimension of systemic risk. The cryptocurrency market had been through its own purgatory. The 2022 collapse of FTX and the subsequent criminal conviction of Sam Bankman-Fried had been supposed to clean house, to eliminate the bad actors and leave the industry stronger. Instead, it had simply driven the risk deeper underground. By 2025, Bitcoin had experienced violent swings that suggested massive leveraged positions being forcibly unwound. Tether, the stablecoin that was supposed to maintain a one-to-one peg with the US dollar and claimed to hold reserves backing every token, faced persistent questions about the quality of those reserves. Was it actually backed by cash and treasury bills, or by commercial paper from Chinese real estate companies and other questionable debt? Nobody could audit it properly. Nobody knew for certain. But Tether's market capitalization exceeded $120 billion. If it broke, if confidence cracked, and everyone tried to redeem at once, the cascade into traditional finance would be instantaneous and catastrophic. The crypto connection to systemic risk ran even deeper than most understood. Major financial institutions had quietly built significant exposures to digital assets, not just through direct holdings, but through prime brokerage services to crypto hedge funds, through loans collateralized by Bitcoin, through derivatives that referenced cryptocurrency prices. When Silvergate Bank and Signature Bank failed in March 2023 due to their crypto exposures, regulators had managed to contain the damage. But they hadn't eliminated the connections. They'd just made them less visible. Banks learned to obscure their crypto activities, to route them through offshore entities, to structure them in ways that didn't trigger regulatory red flags. The exposure metastasized in darkness. And in late 2025, when Bitcoin experienced a 40% crash over the course of 3 weeks, following disappointing inflation data and fears about renewed central bank tightening, liquidations in crypto lending markets began triggering margin calls in traditional finance. The walls between crypto and the mainstream financial system weren't walls at all. They were tissue paper. The psychology driving all of this was perhaps the darkest element of all. In boardrooms across the world, executives had convinced themselves that this time was different, that modern risk management was sophisticated enough to prevent another 2008, that central banks would always step in to prevent systemic collapse. This moral hazard, the certainty of bailouts, had encouraged ever more reckless behavior. Why maintain prudent leverage levels when you know the Fed will cut rates if things get bad? Why worry about liquidity mismatches when government support is always just one crisis away? The lesson of 2008 hadn't been, don't take catastrophic risks. The lesson had been, make sure you're big enough and connected enough that your failure would break the system. Become too big to fail, and you become immune. This perverse incentive structure had guided a decade and a half of decision-making, producing exactly what you'd expect. Massive, concentrated, interconnected risk that nobody wanted to acknowledge until it was too late. The true scope of the nightmare emerged in December 2025, when a mid-sized insurance company named Sentinel Financial filed for bankruptcy protection. On the surface, it was unremarkable. Another victim of poor investment decisions in a rising rate environment. But when bankruptcy examiners began pulling back the layers, they discovered something that sent ice through the veins of every financial regulator in the world. Sentinel had been writing credit default swaps, insurance against corporate bond defaults, on a massive scale, with exposure totaling over $400 billion. $400 billion of insurance against corporate defaults, written by a company with just $15 billion in assets. The leverage was obscene, but it got worse. Sentinel wasn't alone. The examiner's report revealed that at least 7 other mid-sized financial firms had similar positions, creating a web of counterparty risk that, if triggered by a wave of corporate defaults, could vaporize hundreds of billions in supposed insurance coverage. It was AIG all over again, the same credit default swap bomb that had nearly destroyed the financial system in 2008, rebuilt and rearmed in the shadow banking system where regulators weren't looking. The fuse was already lit, and this time there might not be enough government firepower to stop the explosion. The revelation triggered a reassessment across the entire financial landscape. If Sentinel and its counterparts failed, who would be left holding worthless insurance policies? Pension funds, mutual funds, retirement accounts. The savings of millions of people who had no idea their financial security was backstopped by companies with leverage ratios that would make a casino operator blush. The credit default swap market had grown to over $10 trillion notional value globally, meaning the total value of debt being insured was $10 trillion. But the capital actually backing those insurance policies was a fraction of that figure. It worked fine as long as defaults remained rare. But in an environment where corporate debt had reached record highs, where zombie companies were failing in increasing numbers, where the debt maturity wall meant hundreds of billions needed to be refinanced at much higher rates, the probability of widespread defaults was rising exponentially. And when those defaults came, the insurance would evaporate, revealing that the safety net had been an illusion all along. The parallels to 2008 became impossible to ignore, but with crucial differences that made the situation potentially more dangerous. In 2008, the crisis centered on residential mortgages and the big banks that held them. Regulators knew where the bodies were buried because they could inspect bank balance sheets. In 2025, the risk was distributed across shadow banking, private credit, crypto, corporate debt, and commercial real estate. A hydra with heads in a dozen different sectors, many of them beyond the reach of traditional oversight. Central banks had fewer tools available. Interest rates were already elevated in the fight against inflation. Cutting them dramatically would reignite price pressures. Government debt levels in major economies had exploded during the pandemic. Another massive bailout would test the limits of sovereign credibility. The ammunition that had been used to fight the last crisis was largely depleted. If this dam broke, the flood would have to run its course. Cryptocurrency markets, meanwhile, had become a perfect storm indicator for broader financial stress. The correlation between crypto sell-offs and stress in traditional credit markets reached historical highs in late 2025. When corporate bonds sold off, Bitcoin crashed. When margin calls hit crypto funds, traditional tech stocks tumbled. The markets had become a single, unified system, separate in appearance but connected through leverage, through cross-market arbitrage, through the simple fact that the same pools of capital were playing in both spaces. Retail investors who thought they were diversifying by holding both stocks and crypto discovered they'd simply doubled down on the same bet, that cheap money would last forever, that asset prices only went up, that the party would never end. When leverage unwinds, diversification is an illusion. Everything correlates to one. Everything falls together. The commercial real estate situation evolved from a concern into a crisis throughout 2025. Office vacancy rates in major cities reached levels unseen since the Great Depression. The remote work revolution, accelerated by the pandemic, had become permanent. Companies realized they didn't need vast office footprints. Employees had proven they could be productive from home. The result: billions of square feet of commercial office space becoming functionally obsolete. Property values cratered. Loans backed by those properties went underwater. Regional banks with heavy CRE loan books faced a slow-motion catastrophe. The mathematics were brutal and inescapable. When a $200 million office building becomes worth only $100 million, somebody eats that $100 million loss. Either the property owner declares bankruptcy and walks away, sticking the bank with the loss, or the bank tries to work out the loan, taking losses over time through reduced payments and principal forgiveness. Either way, capital disappears. And when banks take losses, they reduce lending, tightening credit conditions, making it harder for businesses to operate, triggering more failures in a self-reinforcing doom loop. The international dimension added layers of complexity and danger. China's property sector, which had already experienced significant stress with the Evergrande collapse in 2021, remained a festering wound that refused to heal. Country Garden, once the largest developer, had defaulted on its dollar bonds. Property prices in major Chinese cities had fallen 30% or more from their peaks. The wealth effect was massive. Chinese households held the majority of their savings in real estate, and watching those values evaporate destroyed consumer confidence. But the connections to the global financial system ran deep. Western banks had exposure through loans and bonds. Commodity markets depended on Chinese construction demand. And most insidiously, the financial engineering that had occurred during China's boom years had tied countless counterparties together through derivative contracts, through offshore vehicles, through the shadow banking connections that regulators in Beijing didn't fully understand, and regulators in Washington couldn't see at all. If China's property sector truly collapsed, not just declined, but experienced a systemic failure, the global repercussions would be automatic and devastating. The business lessons emerging from this unfolding catastrophe were as old as finance itself, just dressed in modern complexity. Leverage is a double-edged sword that cuts deepest on the way down. Short-term thinking produces long-term catastrophes. Regulatory arbitrage, moving risk to less supervised parts of the financial system, doesn't eliminate risk. It just makes it harder to see until it explodes. And perhaps most importantly, moral hazard poisons everything. When major financial players believe they'll be rescued from the consequences of their decisions, they make increasingly reckless decisions, pushing risk to extremes because the downside isn't their problem. The asymmetry is perfect. They capture the upside through fees and bonuses, and taxpayers absorb the downside through bailouts. This isn't a bug in the system. For those at the top, it's the entire point. The psychology of financial manias remained depressingly consistent across centuries. Dutch tulips, the South Sea bubble, the Roaring Twenties, the dot-com boom, the housing bubble. Every cycle followed the same pattern. Initial innovation creates genuine value and excitement. Early participants make money, attracting more participants. Credit expands to fund ever larger positions. Skeptics are dismissed as outdated thinkers who don't get it. The music plays faster and faster until suddenly it doesn't. Someone tries to cash out, then others follow. Then it becomes a stampede. The people who thought they were geniuses during the boom discover they were simply riding leverage in a bull market. And the people who built the most leverage, who took the most extreme risks, who told themselves they were masters of the universe, they fall the hardest. We had rebuilt all the same structures, convinced ourselves all the same lies, and now stood at the same precipice, wondering why it felt so familiar. By the end of 2025, the warning signs were no longer subtle. High-yield bond defaults were running at rates not seen since 2009. Credit spreads had blown out to crisis levels. The inversion of the yield curve, long considered a reliable recession predictor, had persisted for months before finally normalizing. Typically the signal that recession was imminent rather than distant. Stock market volatility spiked with increasing frequency, suggesting that algorithmic traders and institutional investors were positioning for turbulence. And beneath it all, the quiet desperation of companies trying to refinance debt at rates that made their business models unworkable. of banks trying to hide the true extent of their commercial real estate losses, of crypto platforms trying to maintain the illusion of solvency while their collateral evaporated in value. The system was in the process of breaking. The only question was whether it would happen slowly, in a managed decline that authorities could potentially control, or quickly, in a cascade that overwhelmed all containment attempts. Some voices had warned of this moment for years. Economists who understood that you can't solve a debt crisis by adding more debt. Risk managers who watched leverage metrics climb to insane levels and knew how the story ended. Veteran traders who had lived through previous crashes and recognized the signs of euphoria giving way to fear. But they'd been drowned out by the cheerleaders, by the permabulls who insisted that central banks had learned their lessons, that this time really was different, that modern portfolio theory and sophisticated hedging strategies had tamed the business cycle. Those cheerleaders had never experienced a true deleveraging. They'd built their careers during the greatest credit expansion in human history, and they literally could not imagine what came next when that credit contracted. They were about to get an education. The human cost of what was coming remained abstract to most people in late 2025. But it would become brutally concrete soon enough. Every percentage point of unemployment represented millions of destroyed livelihoods. Every pension fund that took losses would mean retirees with less security in their final years. Every wave of corporate bankruptcies would mean communities devastated as their largest employers disappeared. The wealth destruction wouldn't be evenly distributed. It never was. The executives who had engineered this house of cards had golden parachutes, offshore accounts, diversified holdings that could weather the storm. The workers who'd shown up every day and trusted that the system was sound would bear the brunt. They always did. That was perhaps the darkest element of the entire structure. It was designed to socialize losses while privatizing gains, to protect those at the top, while those at the bottom absorbed the shocks. And they'd gotten away with it before, so why not try again? The regulatory response to mounting stress had been predictably inadequate. Central banks issued stern warnings about leverage and financial stability risks, while simultaneously maintaining the very policies that encouraged that leverage. Politicians demanded accountability while blocking any meaningful reform that might upset their donors in the financial sector. Bank executives testified before Congress that their institutions were sound, that stress tests showed resilience, that lessons had been learned. The same testimony given before every previous crisis. The incentives were perfectly aligned to prevent action, until action was too late. Nobody wanted to be the one to take away the punch bowl while the party was still raging. Nobody wanted to be blamed for triggering a recession by tightening regulations or forcing deleveraging. So they waited and hoped and prayed that somehow it would all work out, that markets would self-correct without intervention, that the problems would solve themselves. They wouldn't. As 2025 drew to a close, the financial world stood at an inflection point. The debt maturity wall loomed larger. Over $2 trillion in corporate debt would need refinancing in 2026. Much of it at interest rates double or triple what the companies were currently paying. The commercial real estate reckoning had only begun. Trillions more in property value would need to be written down as long-term work-from-home trends solidified. The crypto sector remained a powder keg, with stablecoin fragility and exchange solvency questions unresolved. The shadow banking system continued to grow in size and opacity, creating ever larger pockets of risk that wouldn't be discovered until they detonated. And threading through it all, the leverage, the borrowing built on borrowing built on borrowing, creating chains of counterparty risk so complex that no single institution understood its own true exposure, let alone the exposure of the system as a whole. The machine had been designed to extract maximum profit in good times. Nobody had bothered to install brakes for when times turned bad. The dark truth at the heart of modern finance is that complexity is a feature, not a bug. When products and structures become too complicated for regulators to understand, for investors to properly price, for the public to scrutinize, that's when the real money gets made. Opacity is profitable, confusion is valuable, and systemic risk is someone else's problem, right up until the moment it becomes everyone's catastrophe. The architects of this system understood these principles perfectly. They'd studied what worked in previous bubbles and refined the techniques. They'd learned that you could get away with almost anything if you made it complicated enough, if you spread the risk across enough institutions, if you made sure that your failure would threaten the entire system and thus guarantee a rescue. It was beautifully cynical engineering, and it had worked exactly as designed, right up until it didn't. The final accounting of 2025's systemic risk wouldn't be written for years, perhaps decades. Whether this was the prologue to another great recession, or merely a period of heightened volatility that the system ultimately weathered, remained an open question as the year ended. But the ingredients were all present: unsustainable debt, hidden leverage, interconnected failures, regulatory blindness, and the unwavering faith that authorities would intervene to prevent catastrophe. That faith might prove justified. Central banks might find ways to contain the damage, to manage the deleveraging, to prevent cascade failures from destroying the entire system. Or that faith might be the final illusion, the last psychological pillar holding up a structure that had already failed in every material sense, waiting only for enough people to notice before it collapsed. What made this moment truly dangerous wasn't any single factor in isolation. It was the convergence, the simultaneous stress across corporate debt, commercial real estate, crypto, shadow banking, and international exposures, all hitting at a time when the tools to fight financial crises had been depleted by previous interventions. It was a perfect storm scenario, the kind that risk models assigned infinitesimal probability to, because they'd never all happened at once before. But that was the nature of tail risk. It stayed invisible right up until the moment it materialized, and then it was already too late to run. The market crash warning signs of 2025 weren't subtle. They were flashing red across every dashboard. The question was whether anyone with the power to act would choose to look at them, or whether we'd collectively decide that ignorance was preferable to the painful solutions that might prevent catastrophe. In the shadowy world of high finance, there's an old saying: the market can stay irrational longer than you can stay solvent. It's a warning about betting against bubbles, about how timing the collapse is nearly impossible, even when you know one is coming. But there's a corollary that gets discussed less. The system can appear stable, right up until the moment it catastrophically isn't. The calm before the crash often feels like vindication for those who insisted everything was fine. The skeptics seem hysterical, the bears seem foolish, right up until the moment they're proven prophetic. And by then, everyone who ignored the warnings is already trapped in the collapse, watching their portfolios evaporate and wondering how they didn't see it coming when the signs were so obvious in retrospect. That's where we stood as 2025 ended, in the quiet before the storm, with all the warning signs visible to anyone willing to look, but with most people still convinced that this time would somehow be different, that the rules had changed, that the old patterns didn't apply anymore. They were wrong. The patterns always apply. Gravity always wins. And the bill for years of reckless leverage always comes due eventually, paid in the currency of destroyed wealth and shattered faith in the systems we'd convinced ourselves were unbreakable. The true horror wasn't that another crash might be coming. It was that we'd learned nothing from the last one, that the same incentives had produced the same reckless behavior, that the warnings were being ignored for the same reasons they're always ignored, because acknowledging the danger would require sacrificing short-term profits, and that was a price nobody in power was willing to pay. So the machine kept running, kept accumulating risk, kept building leverage on leverage on leverage, kept pretending that infinite growth on a finite planet, with finite resources and finite credit capacity, was somehow sustainable. And somewhere in the darkness of the financial system, in the interconnected web of debts and derivatives and digital chains, the cracks continued to spread, moving toward that critical threshold where the structure could no longer support its own weight. When it would fall remained uncertain. That it would fall was written in the mathematics of unsustainable systems, in the history of every bubble that preceded it, in the fundamental truth that debt accelerates collapse. The only question left was whether we'd be ready when it happened, or whether we'd be caught flat-footed once again, shocked that the warnings we ignored turned out to be accurate, wondering why nobody saw it coming, when the truth was that everyone who looked could see it perfectly. We just chose not to look. Subscribe and listen to our next story below.